Oops, I think we've lost Ms. Bhattacharya, but we probably came in to the final points of the conversation with her as well. Anyways, good having you, Ms. Bhattacharya. Thanks so much for joining in. Okay, Anand Naran is waiting by. We also have Mr. Vinod Aggarwal, CEO of Commercial Vehicles at Eicher, also waiting by as well. And a couple of other guests joining in, Avik Barua and Sajid Chana, I believe, joining in. But let me first take it to Mr. Vinod Aggarwal. He's been with us for a while now. Mr. Aggarwal, good having you. Thanks so much for joining in. RBI not given clear hint towards when a possible rate cut would come in. The bankers too not completely committed on when the rate cut would come in. You just heard SBI speak about it. What are your initial thoughts on when could this come in? And even without the rate cut, would the sales flow for the rate-sensitive auto sector continue?
No, definitely. I think from the industry perspective, we had expected a rate cut, and interest rates are definitely, work on the sentiments of the customer. And CV industry, if you look at the trucks, are 100% financed, and apart from that, the economy also is driven by the interest rates. So the investments, if the interest rates are not cut, it means the RBI. But we see that RBI is only worried about inflation and not about growth. So that is coming out very, very clearly. And in fact, if you look at historically also in 2009, when the growth cycle started, the repo rate was 4.75. It was cut down from 9% to 4.75 in just 1 year's time, from July 2008 to 2009. And from 4.75, then you have seen the growth. And 4.75 went up to 8.5% in next, continuous increases which happened. We have not been able to come out of that syndrome of, high repo rates. And now we had expected...
Right, Mr. Aggarwal, but that's precisely my question. Since that is not seeming like it is going to happen in a hurry, do you believe the sales growth will continue unabated? For Eicher, it's a lot about CV as well, as much as it is about Royal Enfield. Do you think the traction out there would pick up, or do you think it will remain subdued?
Sale growth will continue based on various other factors, because interest rate is not the only factor by which the customers buy it. There is a business. If suppose there is a demand for movement of goods, definitely you would need the trucks. And you are looking at the growth that is happening already in this year in heavy duty trucks. The growth is 35%. Now, if the interest rate is cut, that will give the further boost to the industry. So, if you really want the industry to come back to its earlier peak levels, I think interest rates will also play a very, very important role. But if it is not cut, then definitely we are going to see the growth, but not that much. But the potential is there, to grow more, and that potential will get impacted.
Obik, welcome to ET Now. Tell us, what is your first reaction to the RBI's monetary policy announcement? You're not surprised at all, I guess, like the rest of the market, Obik?
Yeah, no, I think it was very much an expected line. It's very sensible in the sense that the last policy, from what I remember of it, seemed to give the indication that this was the end of the rate cutting cycle, and at least it was perceived that way by a number of analysts. But I think he's clearly sort of highlighted the risks and made also sort of communicated the fact that if these risks were to be mitigated, then there is room for accommodation, and he's sort of actively seeking the space to provide more accommodation in terms of lending rates and so in the policy rate and consequently lending rates and so on. So there are just a couple of comments that I wanted to make, Maithili, before, which is not directly related to the question, but which came up in the policy. I think this thing of there being inadequate transmission, I think needs to be seen in a slightly different perspective. Yes, the base rate has reduced by about 30 basis points, although the policy rate has gone down by 75 basis points. But if you also sort of factor in the compressed spreads over the base rate, particularly for the better companies, then you will actually realize that the transmission has been much more or much stronger than is being made out to be. So there are different ways in which the effective interest rate sort of transmits to borrowers, and I think that's been actually quite effective over the last couple of months. And the other point that I wanted to make, if you allow me the time, is that he, in the press conference, not so much in the policy, he talked about the slow increase in foreign holding limits in government bonds. I am a little uncomfortable about that because foreign ownership of local currency sovereign debt has actually gone up very dramatically, and with the Fed hike round the corner, that could actually lead to a considerable stress among not just India but other emerging markets where a similar phenomenon has happened. So these are a couple of points that I wanted to flag, which are not really sort of in the ambit of the policy statements, but which he sort of referred to in his presser. And so I'm not, I'd just like to sort of set the record straight on this.
Sajid, will you share Obik's apprehension on the hike in FPI limits effectively? And does it seem that the RBI is more concerned about capital flows when it should rightly also worry about exchange? The exchange rate and export performance. In fact, it says export performance has shown the sharpest contraction since 2009-10. Now, that should be something very worrying for a central bank, instead of which the RBI seems completely unconcerned about that and is worried more about the capital flows, which is very undesirable from my perspective for an emerging market.
A couple of things, Matthew. I think we're reading too much into what the governor is saying. I think the details of what he's saying are still to be weighted. I think he's trying to make a broader point that rather than this ad hoc manner in which we raise FI limits every few months and markets are consistently on boil as to whether limits are going up or not, we should begin to institutionalize that process like many other countries do. If you look at neighboring countries of ours, it brings a level of predictability by saying that your FI limit should be a certain percentage of either the stock of issuance or the flow or GDP, some meaningful metric. I don't think he was for a moment suggesting that that's going to happen right now. I share Abhi's apprehensions that right now is not a desirable time, which is precisely why I think the government and the RBI have not acted. I mean, apart from attracting volatile flows now, we are in a situation of surplus liquidity. So if you were to raise those limits and attract another $4 or $5 billion, and the RBI will intervene that and it creates liquidity, then you're exacerbating that problem furthermore. So I don't expect that to happen now. I think they've been quite concerned about this. If you look at the last year, there have been several measures undertaken to improve the quality of these flows and reduce hot money flows. Residual maturities have been increased to 3 years. So I think the RBI was making a larger point that we do want a gradually opening capital account, which everybody thinks is desirable. Let's do it in a more institutionalized manner. Regarding the exchange rate, Matthew, we need to be a little bit careful how we interpret these export numbers. Firstly, 30% of India's exports of refined petroleum products. We've seen a 50% fall in oil prices. So a lot of what you read in the headlines, which is that exports have contracted 20% year on year, are simply reflecting prices, not volume. So the first thing we have to do is to separate out the impact of lower commodity prices and what they have done to our export values and tease out what the volumes are. Is it the case that volumes have been under some pressure? Undoubtedly the case. I would argue the last 2 months we've seen some turnaround in volumes. But in my view, this is not so much an exchange rate issue. We've done a number of studies on this in the past, that India's export volumes are increasingly influenced by what happens to global growth. And we've seen in the last year, we have consistently seen global growth disappointments, whether it's in the US, whether it's in the Euro area, whether it's Japan, whether it's China. So every other emerging market at some level is afflicted by that and whose exports have struggled. So I would not go so far as to say that India's exchange rate policy is killing exports as of now. I agree we should have a gradual depreciation over time, which should offset inflation differentials.
As far as the RBI's liquidity management is concerned, is there something a little difficult to comprehend really about the RBI's excessive operations of mopping up liquidity? Every time liquidity seems a little comfortable and there might be scope for banks to cut interest rates because liquidity is comfortable, the RBI comes in and absorbs some liquidity. What explains the RBI's desire to mop up liquidity really?
Is that for me, Madeline?
Yes, I did. That's it for you only.
Yeah. No, it's very simply, it's part of that operating framework. The operating framework calls for them to keep the call rate very close to the policy rate. And so if you did not mop up that liquidity, the operating rate or the call rate would become the reverse repo rate, which is 100 basis points below. Now that's tantamount to cutting interest rates by 100 basis points, because that's effectively the rate that's the marginal cost of funds in the market. So it's very clear that we decide on a policy rate, and we want the operating rate of the market to reflect that policy rate. So when liquidity is very tight, they would work in the opposite direction to ensure that the call money rate is close to the repo rate, and when liquidity is in surplus, you would mop it up, right? So I don't think there's a surprise there.
Okay, actually, Mr. Aggarwal, I kind of asked the same question to you in a different way, and it's probably a question best put to your CFO. But how has been the liquidity situation for corporate India right now? Because a lot of companies that we speak to were complaining 3 months ago about problems being there. Things seem to improve a little bit. What is your sense out there at iShares?
No, I don't see any concern as far as the liquidity is concerned. So we have enough liquidity. But the concern, this credit policy impacts our customers as well as the general business sentiments. Because the economy, it has to grow. And then our sales are also linked to economy. So from that point of view, we would have liked the interest rates to cut down and the growth to happen more in the economy. That's not happening, and that's a concern. As far as we are concerned, liquidity is not a concern.
Mr. Aggarwal, commercial vehicle sales are often taken as a lead indicator of the economy. In your case, does that mean that the economy is not really going to improve? On what explains the difference in how commercial market vehicle sales are doing and passenger cars are doing? There doesn't seem to be any dip as far as passenger cars are concerned. So is that the end, the tail wagging the dog?
No, commercial vehicles, if you look at commercial vehicles after this recession of around 3 years, from 2012 to 14, commercial vehicle, the cycle itself has turned positive, because after the downturn, the positive turn has to happen. So commercial vehicle is on the upswing, and as a result of that, the haulage segments are growing very well. Now the concern in commercial vehicle industry currently is the infrastructure related growth. Like for example, the construction trucks. Construction trucks are still dropping. So that's a major concern. If the infrastructure sector doesn't move up, or if you don't see the action in the road construction or in the other infrastructure projects, then we won't see the real growth, overall growth happening in the CV sector. So CV sector, infrastructure projects are not moving. As a result of that, the construction trucks are not moving. Light and medium duty trucks are still down, because even though the decline has stopped, but they are not growing, because those are also impacted by the rural sentiments, because the smaller trucks or the light and medium duty trucks are more used in the rural segments for the transportation of the agri products or other such products. So that the rural sentiment is down because of the monsoon worries and because of few other factors. So light and medium duty drop has stopped, but it is not growing. However, the buses, like the passenger segment, that is also growing very well because of the good growth in the school buses or in the staffing segment. But on the other hand, like the JNNM scheme, which earlier government was running, now that scheme has majorly got impacted, and because now they have new government has come out with a new scheme which is called Amrut. But that scheme has not fully taken off, and whatever actions were happening under the earlier scheme, those also have been stalled. So really the buying by the state transport undertakings has got impacted. So I think the government has to work on the infrastructure projects, and similarly on this Amrut scheme, they have to ensure that the schemes take off. And then of course the interest rates, we would have expected that interest rates should give the further boost to this sector, which is not happening.
Absolutely. Thank you so much, Mr. Aggarwal, for joining us. But Obik, if I can take that question over to you. You know, a lot depends on government doing something to kickstart the infrastructure sector. And the government has started spending. How long will you have to wait before we see it really translating into something on the ground?
Well, I think there are some things that are actually translating on the ground. For instance, from what I hear in the road sector, activity has picked up in certain pockets. I think they're working on very critical institutional arrangements that had become a bit of a bottleneck. For instance, you have this more hybrid PPP structure rather than the old plain vanilla PPP model. So I think that it's already started. It's sort of gaining traction. I think within 6 to 8 months in certain sectors you will see considerable activity, and as Mr. Aggarwal was saying, that some of the cyclical sectors like commercial vehicles are directly and quite obviously related to activity in infrastructure like roads. There is a clear problem in power, which was discussed very extensively by Ms. Bhattacharya, and also I think Dr. Rajan made a reference to it. I don't think there is enough happening there because of very long-term sort of legacy issues that still plague the sector. But I think the government is giving a push not only to infrastructure but also to sectors like defence and so on that are, for obvious reasons, not very visible in terms of their revenue impact and so on. So to put it in a nutshell, things have started picking up. There is traction, but I think this is not going to be a full-blown investment recovery where both the private and public sector participate across the board. So it will be selective and consequently slow.
Okay.
But it's not.
Sure. Okay. Okay. Fair call. Avik, can I have a question for Sajid? But before that, let me just get on the show Sanjeev Sanyal as well. He joins us right now. And Sanjeev, RBI's commentary indicated that risk on inflation target is balanced, but do you think that leaves the headroom for the RBI to cut interest rates in the rest of the fiscal, or will the Fed weigh in on its mind?
As I said, I mean, I'm of the view that we should be cutting rates much more aggressively. Almost every indicator, after all, inflation is not the only indicator of dynamics in the economy. Every other indicator, particularly credit growth, wholesale price index, corporate profitability, and so on, suggests that there should be significant reductions in interest rate. So I think proactively the central bank should have gone ahead and reduced rates. But I think given the statement, we are probably being led to cuts in the near future.
And your answer seems to suggest that you probably believe the RBI is behind the curve on addressing growth concerns. Sanjeev?
I think growth is trundling along. It's not really gathering steam. It's true that the rest of the world is slowing, particularly China, and there are concerns in Europe. But the fact of the matter is India is growing well only relative to others. I have some skepticism about the new GDP series, but I think on the whole, if you were using the previous series, India is growing at somewhere in the range of a little bit above 6%, which is not bad given the global context, but I think we could quite easily get this to gather pace.
Okay. Thank you so much. But Sajid, if I can turn to you now, the RBI's next monetary policy announcement is slated for the 29th of September. Now, ironically, the Fed next meeting is also on the 28th and 29th. So will we see RBI again postponing? They've done it once before. Or will they just go ahead and announce what they have to say? And then subsequently, depending on what the Fed does, we might see something out of policy action?
I'd be surprised if they'd postpone it. I know this happened once before, but that was when the governor had just taken over and we didn't have this new framework. I think a couple of things to point out. One is I think the RBI has been quite pragmatic this year. Whenever they've believed, let's not forget the overarching framework here. They've been given a legal mandate by the government to keep CPI inflation below 6%. So you have to forecast where inflation is going. Each time they have believed that their inflation forecast is below 6% and there is space to cut rates, they've cut rates in the first 6 months of the year. My sense is in the next couple of months, there are lots of moving pieces here. What happens to the monsoon, what happens to growth and therefore to core inflation, what happens to capital flows, the exchange rate and the Fed. If in the next couple of months there is a sense that inflation is below their forecast, remember their forecast currently still has inflation at 6% with more balanced risks. If you undershoot those numbers in the next couple of months, my sense is there is potentially space for one more cut and the RBI will typically act sooner than later. While the Fed is going to be an important part, I think there are two things to keep in mind. One is we'll have a clear sense of what the Fed's going to do, I think on a more clear sense, in the run-up to the Fed. So when we have the non-farm payrolls number this Friday, you get the September print, it'll be much less of a surprise as to what the action is going to be, and therefore much of the market reaction could well be priced in or happen in the run-up to September 28, 29, number one. And number two, India is far more protected, far more insulated from global shocks for all the reasons we've discussed. The current account has collapsed, the balance of payments is in a strong surplus, reserves have built up by $100 billion. So in that sense, you know, while the Fed is going to be one factor, I don't think it's going to be the overwhelming factor. If the RBI believes inflation is on a path to track below 6%, I think they'll cut rates one more time, despite what happens with the Fed globally.
Okay, so even though the RBI itself acknowledges that the Fed will be a major factor, you feel that they are sufficiently confident given the fact that they have, for all the reasons that you mentioned. But Sajid, if you look at the quality of our reserves, is the quality of our reserves really kosher, or should we also worry about not just the quantity of reserves, but also the quality of the reserves? In that case, it becomes much more suspect. Sajid?
Maitli, I just think we can always sort of talk about elements, quality of reserves, whether any amount is enough, and there are no limits to that. I just make the simple point that if you look at what the reserve situation is today compared to 2 years ago, we're far better protected. If you look at where currency expectations are, they're far more anchored. And more generally, if you just look at balance of payments dynamics in India, if oil prices are going to be between $50 and $60 a barrel, you're looking at a current account for the entire year, which is somewhere between $25 and $30 billion. Now, just FDI flows last year were close to that, and this year we'd expect it to be above 30. So even if India gets zero portfolio flows for this entire fiscal year, you only get FDI, NRI deposits, trade credits. We're in a comfortable BOP surplus. So I don't want to make the case that the Fed's going to have no bearing. Absolutely not. I'm just saying that the likelihood that there's a very disorderly impact on the rupee, which is going to force the RBI's hand, is much lower today than it was in 2013 because of all these other mitigating factors. And therefore, the influence on rates, while existing, will be less than what it was 2 years ago.
Okay, gentlemen, on that note, thanks so much for joining in today and giving us your perspectives on the policy and the RBI action. We've been here non-stop for the last 2 hours. Really good having you and your opinion on board. And Maitli, as always, thanks so much for joining in and taking us to this discussion as well. The equity markets, well, they're not too perturbed. Actually, for a brief moment, they've done extremely well for themselves. And now there is a bit of a dip again. So about 0.5% down for the Sensex.